Hey folks, it's Rob Flux here for another Sunday session, and today we're going to be talking about the one-on-one on how to start to scale your developments. There's a lot of us in our network who start out really small, typically with residential lending, and then when we start to scale, we start hitting these glass ceilings with residential lending, not really dealing with what it is that we're trying to do, and we need to start to break into the commercial space, and a lot of us don't know how that works and the like. So for today's chat, we have Daniel He from CrowdProperty, and we're going to welcome Daniel in. Hey, Daniel, how are you, mate?
Very well, Rob. Great to be here with you.
Thank you. And what we're going to be doing today, mate, is we're going to go through, I guess, the real basics for everyone, I guess, wanting to know how to start to scale their developments from, I guess, small scale into the commercial space, and break it down into its simplistic elements so that when they go and talk to people like yourself, they're not bamboozled by all the jargon and the technical mumbo jumbo and the like. How does that sound? So see if we can scare them off a little bit, hey mate. Firstly, you're from CrowdProperty. Many people may not have heard about CrowdProperty. So tell us who are CrowdProperty and why is it that we should be listening to you today, mate?
Yeah, thank you, Rob. Look, CrowdProperty is a marketplace lender, so it's an online platform that solves the problem of connecting property developers on one hand who are looking for finance for their projects, and it connects them with investors on the other hand who may have some money parked away in an interest-bearing account and want their money to work a little bit harder. The core of our business, we've been running for about seven and a half years over in the UK. And in that time, we've lent a substantial amount of deals. We're looking at hundreds of millions of pounds of deals that we've funded, and we've probably looked at roughly around £3 billion worth of deals across our desk. And since our launch here earlier in this year, we've looked at a substantial number of deals here. The key part of what we're trying to solve is not understanding property developments. You go to lenders who are commercial lenders and try to finance cars and businesses. The core part of what we do is funding property and property development related products. And so that's where we come in. And my experience and background also is as a developer, been involved in joint ventures, investing, funding, advising as well. So my background is really on both ends, the lender end and also the development end, and hopefully that provides some insight and some value to your listeners today.
Perfect, mate. Well, let's start with the very beginning. We're going to talk about the 101 of this space. So why don't we start with the primary difference between residential and commercial, and why it is that people, as they start to scale, want to start to move away from residential. So the first part is probably understanding the difference between serviceability in trying to service a debt versus capitalizing your interest and things like that. So give us some insights into just that realm, mate.
Yeah, so it's very important to also just highlight the residential and the commercial lending. That's completely separate from the underlying property deal you're trying to do. So if you're doing a 1:2 subdivision or a 1:20 subdivision, it doesn't change that. It's just the nature of the lending and the way we look at that lending to fund that particular project. So glad you brought up the serviceability part. You look at some deals that are 5, 10, 20 million, and you think, man, what do I need to be earning on an annual basis to be able to fund that deal? And that's how you examine it from a residential lending perspective. From a commercial lending perspective, it's not about what your income is on a yearly basis. It's about the deal itself, and it's about interest that's capitalized. So what does that mean? So it means that you're not paying down the interest of the loan on a monthly basis. You're taking that interest, you're wrapping it up, and you're paying that at the end of the project when you sell or when you refinance that project. So that could be 6 months away, that could be 12, that could be 18 months away before you need to dip into your pocket to fund the interest. And the benefit of that is it provides cash flow for the developer, because you're not getting cash flow in while the development is happening, right? You're paying out to your builder, you're paying out to your consultants. So that really helps from that perspective. And the second part of that is, because it's not looking at your earning potential, you can potentially infinitely scale your projects in terms of the number of projects as well as the value of those projects. So instead of doing 1 into 2s, you could be doing 1 into 5, 10, larger land division and the like.
And I think that's a really important thing to concept that we want our members to actually understand, because quite often they're putting glass ceilings on themselves because they've been indoctrinated into the residential lending space, and that the fact that they must have serviceability and they must be able to fund the debt. And I guess the way that the residential lenders are looking at these loans is they're looking at this as if it's going to be owned for 30 plus years. Okay. And so they're trying to assess the fact that somebody can actually slowly pay down the project. And you touched on it a moment ago. I guess in the commercial space, you're not looking at that for the 30-year lifespan. You're looking at that for the lifespan of the deal itself, and you're looking at the deal on its own merits and the profitability of the deal.
Yeah, that's correct. And typically we'd be in deals for anywhere between, say, 6 months to 24 months, whether it's a bridging loan or a construction loan, for example. And once you sell the product or once you refinance the product, we will happily exit at that point. So this is, I guess, how we look at a deal, and we specialize in that particular time frame of your property development. When you decide to hold it for the longer term, whether it be 5, 10, 20 years or longer, there'll be plenty of people in the market who will assist you on that part once it's built and complete and ready to be either tenanted or already sold.
Yeah. So I like to break this down into really 3 stages of the funding process. There's the initial acquisition itself, when the property has no development approval, where at the moment it still is a house. There's no guarantee on the outcome of that. Residential lending is a fantastic place to start in that particular realm. Then you've got your development approval, and you want to start to scale your project and start to do the construction elements. And that's where the transition over to commercial starts to work really well. And then the third stage is keeping any residual stock that you might want to keep in there. Once you've sold down some of your stock, you've got any residual debt or maybe some stock that's a little bit slow to move. So if we think of them in the 3 different phases, now from a commercial lending perspective, the sweet spot's right in the middle, but you can play at the start at the acquisition stage as well, can't you?
Yeah, absolutely. We can play throughout the process in all three stages, and it's really important that you've broken it down to 3 stages, because you think of commercial finance and you think it's one loan. No, it's 3 different stages, and typically at each stage it needs to be refinanced out either by the same funder or a different funder. So, for example, you purchase a property, call it 1,000 square meters. And you're looking to get a DA approval or development approval on that particular site to do whatever it may be, 3, 4, 5, 6, 7 townhouses. And before you do that, what you're looking to do is you're looking for a loan amount to help you settle the property, or if you've negotiated well and you have a longer term settlement under an option, that's even better. But you're essentially looking to settle that property. So that's the initial phase. And once you've received your DA approval, what that does is it does 2 things. One, it de-risks the project from your perspective, so you've got some certainty around how many you can actually put on that particular site. It also de-risks the project from a funder's perspective. So we look at that and say, right, okay, Rob, you've got a great project here. It's been approved. We know what you can get on that, and that certainty creates some value. So you may have purchased that property for $1 million, and that may now be worth 1.05, 1.1, 1.2, because you've got the certainty of the DA approval there. And then on the last part, once you've got the DA approval, you've started construction, you've gone through the construction process. Should you have any residual stock left over, it's not typical in this market in this particular time. A lot of stock is selling really well and really quickly for really good prices at the moment. But in a few years' time, things can change, and even in a few months' time, things can change. And something we can help with developers is looking at that residual stock that's left over. If you've gone and spotted a brand new deal that you want to get into, but you want to transition from one deal into another, for example. So that's an example of how flexible we are, playing across the three different stages, and also being flexible to help you with your next deal as well. And that's really our ethos. We're a partner in the development process with you. We'd like to see ourselves as somebody there to assist you in your journey, not just to finance your project.
Yeah, absolutely. Now, coming back to that, I guess the differences between residential and commercial, the fact that a residential lender is looking at that for a 30 plus year term, and you're looking at it for a 12-month or a 2-year type term, that inherently means that the residential lender is getting their money over many, many years, and they can be like McDonald's and get 50 cents a hamburger, but a lot of hamburgers, and do that over and over and over. So their interest rates are really, really low. And they know that they've got the likelihood of capital growth in that property. Whereas a commercial lender is in that deal for a very short period of time, has to take all the risk and share that risk with the developer, and needs to make their money in that very short period of time. So there's a difference in the interest rates, which sometimes that interest rate number can actually scare people. They see, 2s and 3s in a residential lending perspective, and in the commercial space, it can be much, much higher. Why is that something to not be scared about? The actual interest rate itself, why is that something not to be scared about?
Yeah, it's a very, very good point that you raised, Rob. And interest rate is important. We all want the best deal that we possibly can in every development that we do, because it's a numbers game, and it has to work for us, our investors in the deal, our equity investors. The important thing here is looking at it from a scalability perspective. So let's say you've already got 3 deals on the run, Rob. Let's say they're all 1 into 3s, and you've got a horizon of probably the next year and a half to build them out and to sell them. But the deal of the century comes along, and you've got a healthy profit on cost. It's a relatively larger deal, and you look at your serviceability, and you go, well, can I really service that? Can I take on another loan to service this deal? So what typically people do is they go, well, okay, well, if I can't service it, maybe I can flick it for a quick finder's fee. I can get a JV partner onto the deal and have them do residential funding. But the issue with doing that is you're actually leaving a lot of profit. You're actually leaving a lot of money on the table. And ultimately, in my opinion, is you want to be doing that deal yourself to realize and to farm that project for the profit that's there, because you see the potential. You see that in 2 years' time you'll be getting a substantial amount of that deal that you wouldn't otherwise do. So here's where commercial funding can give you an alternative option, which is you remain in control. You're not sharing the profit. You're banking all of the profit in the deal, particularly in an environment like this, where your end sales values are going up day after day. And at the end of the day, you remain in control of your project. And yes, you might be paying higher interest rates. You might be paying low single digit, and there are some commercial funders who are a little bit higher than that. But at the end of the day, you're doing another deal, another potential 2 deals or 3 deals that you would otherwise be doing. And that's how I look at it. Your opinion might be a bit different there, Rob, but it's about scalability and flexibility to help you do the deal.
Well, it's all of that and more, mate. It's the fact that you touched on it before, because you're not servicing an interest rate every single month. That liquid cash can go towards the running of those extra deals. So the ability to actually afford to run those and use the same amount of cash to run many things at the same time. So for me, I look at the interest rate not from a, oh my God, that's a scary interest number, but rather what's the actual cash cost of that? And I put that as a line item in my feasibility, and it's just a cost of doing business. And if I make money doing it at whatever interest rate that there is, and I've paid some pretty scary interest rates in the past, but I did so because the deal made sense, and I wouldn't have been able to make the deal happen if I didn't pay that rate. Now, that's not to say that all interest rates have to be scary, but you touched on at the moment, typically we're in the single digits still at the moment, but that's obviously going to be deal specific and risk specific. So, which comes down to how do you guys start to assess that?
Yeah, it's a very good question. But before we move on to that, I just want to say also that a share of profit in a smaller share of profit in a deal is better than no profit at all by not doing the deal, right? So that's really important to put that front and center. Look, how do we assess a deal? We look at the deal on its own merit. So we look at the deal and we say, look, is it what sort of development is it? Is this the right product in the right area? What do your numbers look like? Is it a profitable deal that will allow you to finish in the time specified? And typically lenders, as we do, will add a little bit of buffer on that. So for example, we had a developer come to us saying that their deal will be complete and built. It's already DA approved. It'll be done in about 9 months. And we looked at it and we said, oh, you've got some difficulties here that you might need to address. So we'll say it's probably 14 or 15 months. And we'll offer a loan provided it fits our metrics of that longer time frame. So if you finish early, then you don't get penalized. There's no exit fees. There's no early repayment fees. We just high five you and we try and go again for the next deal. And the other part of that is in the assessment of the deal. We look at who the sponsor is as well, who the person running the development is, who the team is. We look at, like I said, is the product suitable for the area? For example, if you're in an area of retirees, is the double-story townhouse with all bedrooms upstairs the right product you should be building? And part of that is sending through the information to us for assessment via hopefully an information memorandum, which is a topic on its own, Rob, which we can delve into.
What I'm noticing, Daniel, is a couple of little bits of jargon in there that I'm going to start to break down and try and help our guys out if you're okay with that. So you touched on the sponsor. So let's talk about the sponsor. That's a term that I hear quite a lot whenever we're talking to, I guess the commercial lenders out there. So what is a sponsor? So I'm coming to you with my very first deal, and it's this big, and it's the first time I've ever done a deal this big. When you have a look at that, how do you start to treat me, and how do I guess, encourage you to want to lend me on that deal?
On that deal, yeah. Look, the sponsor, in its strict definition, is the person or entity that champions the project. So they're responsible potentially for acquisition, getting finance, getting the DA approval, finding the builders. Basically, responsible for the entity. Now, you may have other investors or equity investors in the project. So that person represents the interests of all of those investors. Now, the sponsor themselves typically will have some equity as well. They will have some what they call skin in the game for the project, and so they're not running blind. They're in the project along with all of the investors on the project as well. In that example that you gave, Rob, one of the things that we look at and all financiers look at is how much experience have you had? Are you the right person for the project? Now, don't get me wrong, there's a first time for everything, right? There's a first time that you're doing a 1 into 2. There's a first time you're doing a 1 into 30. And we look at that and we say, okay, well, you may have a 1 into 30 subdivision and build. You haven't had that experience before. What sort of comfort can you give us to say that you're experienced enough to run the project? So that might come in the form of, right, okay, well, you can have more than one sponsor. You can have somebody else on the project that has a lot more experience and is an investor in the project and can help you along the way. So that's one way you can firm up the experience there. Another way might be your team. You could have a project manager, or you can have your architect, your consultants, your your town planner who can guide you in your journey. And the third one is having a mentor, the likes of yourself, who can assist with the project to provide you guidance, and to provide you advice, and where to step and where not to step, because there's some unknowns, and you don't know what you don't know, Rob.
Yeah, absolutely. And when you say you don't know what you don't know, after 32 years of doing this, what I do know is I'm still learning every single day. And so every time you're stepping up in deal size, you want to be making sure you've got someone sitting over your shoulder to help you out. I've got two mentors. My mentors have got mentors. You can never know less, Daniel.
I totally agree with you. And, we don't have the answers for everything, but I'm convinced that, between you and I and the network that we have, I'm sure there'll be somebody out there with the answers, right? And that's part of the journey, and that's part of not going it alone on your own, especially some of these bigger deals that we speak about.
Very good. So you mentioned, I guess, the team. Like, what's depending on obviously on the size of the deal, etc. But who are the people that you would expect to see in that team on a typical application basis?
Yeah, absolutely. Now, the sponsor could also be your development manager, project manager. So that can have some overlap. So that's the person that champions and represents all of the equity investors. We expect that on every single project. And depending on the project, there'll be a variety of engineers. There will be a variety of other consultants, surveyors, architects, town planners, geotech, hydraulic engineers, building surveyors, and the like. What we're looking for when we assess a deal is why you've chosen the team that you have chosen. With the architect, it may be that they've won awards for this type of development in the past, or if it's an engineer, they're a local engineer who know the council regulations very well and are very specific in their knowledge, and can provide insight as to what that council is looking for when you're dealing with geotech or hydraulics, for example. But the key thing here is tell us why you've chosen that team. And they may have come from contacts that or other people in the network. Are they local? Do they have knowledge in a specific area, and have they done projects in the past? And if this is their 10th project of a similar size in that same area, then that's pretty good experience. If they've never done one and they're based in WA and you're trying to do a deal in Queensland, well, that may be raising a few questions. So we delve into that a little bit further, and what we're looking for is congruency, I guess. What the reasons why you've picked the team that you've picked.
Absolutely. So, mate, let's try and break down some terminology, some jargon, lingo, however you want to put it, where a lot of people are used to certain terminology when they come in the residential space, and when we come into the commercial space, the name of the same thing sometimes changes form. So, for example, a deposit in residential space is now started to refer to as equity, as an example. So let's talk about equity. So in coming into a typical commercial type loan, the equity component in a residential loan, they'd typically be looking for a 20% deposit. Sometimes you can get as low as 10, but when we come into the commercial space, you guys are looking for a little bit more, I guess, equity in that. I guess, firstly, how much more and why?
Yes, it depends on a deal by deal basis, and that's the flexibility of commercial lending. Where let's go back a little bit. Let me rephrase that a little bit. So residential lending, you're typically looking at 75, maybe 85% of the settlement, plus about the same for the construction part of that deal. Now, in commercial finance, as we said earlier, we don't look at your serviceability. We care a lot less about what you're earning per year from whether it's development or your other day job. What we do care about is the deal itself. And so, in assessing the deal, the flexibility that we exercise here is is basing the amount of equity you need to put in as part of the total development cost, or as part of the GRV, or the gross realization value. Now, the intricate part of that is, typically in residential lending, what you're looking at is the settlement of the land itself, and then the construction cost, or the build contract itself. In commercial lending, we're far more flexible. We look at hard costs and soft costs. What are soft costs? Well, soft costs are things like consultants that we spoke about earlier. It can even extend to things like bonds with council to fund your to get your titles earlier from a development. Hard costs are, of course, the physical, construction costs. So we're a lot more flexible. We can account for a lot more of the costs. So yes, to answer your question, typically on paper it appears that we may need more equity or deposit for the deal, but in a lot of cases, actually, especially when there's that value add with the DA, we find that it can sometimes be equal, or you could actually borrow more because you've earned the equity, or you've added value in other ways.
So thank you, mate. Appreciate that. So, but typically you would find that equity element somewhere in the realm of 30% of that total development cost. Is that the sort of, space that people are looking at?
So look, equity-wise, if we calculate it from a GRV perspective, you would say, look, and different financiers have different targets. So, for example, if we fund up to 70% of GRV, yes, it's 30% on GRV, but that's on the in-sales values, not on your development cost, which at the end of the day may mean that you're potentially putting into the deal significantly less.
So one piece of jargon just triggered another piece of jargon. So you talked about 30% of GRV, right? So let's talk about GRV. So
Yes.
GRV stands for gross realized value.
Yes.
So that is the anticipated sale price of the finished product at the end. So you're effectively lending against a proposed future value of a product that does not yet exist.
Yes, correct. Yeah, correct. So if you're selling each of your townhouses at $1 million exclusive of GST, we can lend up to 70% of that, which is up to $700,000 per dwelling. And if you work backwards on the deal, depending on what your costs are, that could actually mean it's more than what you can potentially get on a residential lend basis.
Yep, absolutely. So thank you, mate. All of that triggered was all based on trying to convert deposit into equity. So now we've got a bit more jargon that we're going to go into. In the residential space, they'll talk about the loan. Okay, so the loan is 80% or 80% loan to value ratio, whereas in commercial space we refer to that as debt. Okay, so I guess so that's from a terminology, just trying to equate one side of the world to the other. What happens when somebody comes in and they don't quite have the equity needed, or they don't quite have the debt needed? Let's break those down into individual elements. If they don't quite have the equity, there is a thing called pref equity or preferred equity. So how does that work, and what's that all about?
Yeah, so for those of you who are familiar with how companies are structured and how business is structured, this is exactly the same thing, but applied to property development. So in a company, you'll have equity, who are the shareholders, and then you would then go and if you needed to borrow money, you would go to a bank, a commercial lender, and you would get debt on that. So in this case, in development, if you didn't have enough equity, what you could do is you could look at pref equity. Now, pref equity has a preferential exit over the common equity, which is your typical equity. So what that means is on the waterfall of funds is, as soon as a property is sold, who you pay back is the first debt holders and the second debt holders, and then your pref equity. And then as a developer, you sit on the common equity, and that is the last two exits. So those, to answer your question, those who hold pref equity, they have a preference of exiting before the common equity holders.
So thank you for the explanation. I might try, for the purposes of our audience, to dumb it down even further. Okay, so if we look at if we try to keep it really, really simple and say, in your old residential world, you've got deposit and you've got the loan itself. You don't quite have enough deposit. That's really the argument here. And what we're saying is we're going to have somebody else lend us the difference in deposit that we're missing, or the difference in equity. And so because they are sitting, we've got our primary debt, they will be typically first mortgage. Then the people that helped us provided a little bit extra deposit, a little bit extra equity, they are the preferred equity people. They would typically have either a second mortgage, or they would blend with the first lender to kind of go into that space. So they get out a little bit early, like you said. So that waterfall is the person with the first mortgage gets paid first, so the person with the second mortgage gets paid second, and the poor developer who's taking all the risks, he has to wait all the way to the end to see if there's any profit left.
The key, you're right, Rob. The developer is taking on the risk and is last to exit. But the key thing here is we're all of a sudden opening up to a whole array of options. And if you're trying to raise, whether it's $5 million, $10 million or more, you've got different methods to plug the gap. Whereas previously you're looking at one joint venture partner, and you're coming up with a deposit from your own bank account. So I guess the message here is, don't be afraid if you don't think you've got enough funds for a deal. There are ways that you can structure a deal to make it work. And this is critical, I think, the importance of structuring a deal and structuring the finance part of it to make it the most beneficial for the developer, and making sure that there's a return of profit for that developer. That's actually key. I mean, I see that as important as getting the deal, and as important as project managing the build, for example. But I'm a little bit biased. I'm a financier, so that's just my opinion.
No, you've got it absolutely right, mate. So it is all about the flexibility, and you're right. It's about customizing the solution to try and fit. So we've gone through the scenario where, hey, I don't have the deposit / equity in order to get across the loan, but there are also instances where you do have that, but the funder isn't, I guess the preferred funder isn't able to fund the entire debt, and you may actually have a shortfall in the debt side of things. So then we have a mezzanine lender or mezz lending. How does a mezz lender work, and I guess what's the space they step into?
Yeah, so mezzanine funding is exactly that term, right? If you think of a mezzanine level, it's sort of the level above, and what it typically means is they sit after the major first mortgage holders in terms of their right to funds. So, for example, again, let's keep numbers very simple. $1 million, you take on a first mortgage of $700,000, and you may have $200,000, which leaves you $100,000 short. And you go, man, where do I get this from? You could actually go to a lender that plays in that space to plug the gap of that extra $100,000. Rates can be a little bit higher because the risk for that lender is sitting behind the first mortgage holders. So they're not, again, remember, they're not the first person to exit, they're the second group to exit. So rates might be a little bit higher, but again, if it allows you to do your deal and multiple deals, it could be a really good solution.
Absolutely. And when we start to put all of those together, you called it, I guess, the waterfall of payments, which is, I guess, understanding it's the first in, first out. Sorry, last in, first out is typically how it goes from the payment side of things. But that's referred to as the capital stack. When you start to go, well, where does this actually fit? So first mortgage is, I guess, at the bottom. Then you've got mezz, then you've got pref equity, then you've got debt. Then you've got equity, I should say. And then after that is hopefully profit. So understanding that capital stack and where it is that you're actually short then helps to actually understand how you actually put together a deal. Now, for me personally, it's something you need to understand that before going to the lender where you're short, before the lender comes and asks you all these curly questions with all this jargon that you don't understand, and you go, oh, I don't know, but it's a cracking deal. Please, can I have some cash?
And look, at the end of the day, it's up to you as the developer to seek out the type of debt or equity instrument that you need. And sometimes you may have 2 or 3 options, which are all good options. And then there are other factors to look at: the ease of doing the deal, how transparent that person, whether they're a equity investor or a debt partner in the deal. And then there's knowledge. There's how well do you think they know the deal, and how quickly can they move to get the deal done? And a lot of that factors in as you do bigger deals and as you do multiple deals. Because we know for a fact through our research that developers spend a third of their time finding a deal, they spend a third of time working out the finance, and they spend a third of the deal running the deal itself. And if we can cut out a portion of that third, and even if it became 10-20% of your time, that frees you up time to do more deals.
Yeah, absolutely. So, okay, now we're understanding the jargon. We understand where our shortfall is on the deal. We've got a cracking deal. We want to start to present that to a lender. How is the lender going to start to assess that? There's different, again, terminologies with regards to how the profit is measured. There's profit on cost, there's profit on GRV, there's cash on cash. There's a couple of different ways that people start to measure things. When the application comes across to you guys, what are you looking at as to how you measure the profitability of the deal?
Yeah, a lot of financiers will look at profit on cost as well as profit on GRV. With us, for example, coming from a property development and also finance background, we're very happy to just examine it from where the developers are coming from, which is your profit and cost. There are some other metrics we look at that are, I guess, alongside that, such as cash on cash return. How much cash do you have, and what's that return over the period of the project? But typically, look, your profit on cost is one that we look at. But just with any formula, with any ratio, it's a result of what you put in, right? So we also look at the background and how you arrived at those numbers. So, for example, if your median price in the area is $1 million, and you've put $2 million for the end sales product, well, that'd be a $2 million townhouse. So we look at all of that, and we look at that in the lens of the overall picture. And the way to do that is to submit your information in a format that shines the best light on the project, and so we can assess it through your eyes, what you like about the project, what you saw in the project, and how you're going to take this project from where it is now to what you envisage as the end product.
Now, I'm going to ask you a loaded question. Okay, so when I talk to almost anyone in my community, and I ask the simple question and say, how much profit do you look for in the deal? I get a very stereotypical, almost in unison. The whole room will call back and say 20% profit. Always they'll say that. But when I say, well, is it 20% profit on cost? Is it 20% profit on GRV? This is where they start like tumbleweeds. Nobody knows actually how to answer that. So when you guys are looking at a deal, what is the actual percentage number that you're looking for, and what are you measuring it against?
Yeah, exactly. So with every deal, we look at whether the risk for the developer is commensurate with the reward at the end. So does the reward justify the risk, and is it a deal that's worthwhile taking on? So that magic number of 20%, that refers to the profit on cost. So how much profit you take out of the back end as a ratio of the costs that go into the project. Now, the costs involve everything from the acquisition of the land to all of the consultant costs that we've spoken about, all of the potential interest that we look at, and then the cost of the build plus any variations that are involved now. Having said that, in today's market, if you're looking at a 1:1 or a 1:2 deal, that may not be possible in many parts of Australia. The market is hot at the moment, and sales values are sailing away as our build costs are rising every day. So is a 20% profit realistic for a average 1:2? It may not be. It may be substantially lower than that. But if you're doing a mixed commercial res that involves 5 stories and on 3,000 square meters, you'd probably be, to account for risk in the deal, you'd probably be aiming much higher than that as well. So again, it's deal dependent. But yes, there is the magic number of 20%, which is out there, and again, it's just depending on the deal itself.
So how low will you go? Like 20% is the magic number. You just said that sometimes that's not achievable. How low can you actually go in order to get the deal funded? Because if somebody's wanting to take on a project, they want to know with a reasonable level of certainty what their lender would actually, consider as a worthwhile deal. Is it 15%? Is it 10%? And then how do you determine, given the size of the deal and the risk of the deal, whether or not that's a risk worthwhile?
Yeah. So for example, if it's a deal where you've got where you're hitting the median price and you've got good comparables in the area, we may very well look at a 15% profit on cost. We prefer that to be around the 18 to 20% mark if it's a 1:3, for example. But remember, you are dealing in commercial finance. So does your project have enough profit so that it can account for the interest rates that are given out there? So that's what we look at. And look, if it's a deal that comes across our table, we'll look at it. And if it's not one that suits, or if the profit margins are too thin, then we'll let the developer know as well before issuing a term sheet, and we'll just politely say, hey, look, it's a little bit skinny at the moment. Maybe you might like to consider X, Y, and Z.
So you threw out another jargon there, a terms sheet. I'll just put a fish hook in that. I want to come back to that one, okay? So let's kind of finish this lending, interest. Sorry, let me rephrase that. Our profit percentage conversation, then come back around to that one. So do you factor in time in that? So, for example, a townhouse project might take 2 years, and if we're getting 20% profit on cost there, when you factor time in, it's about 10% annualized. When you were talking about a 1:2 subdivision, much lower interest rate, but equally you may be finished in and out of that in 9 months. So how does time factor into that assessment for you guys?
Yeah, huge. Which is why you see some renovation projects, and even though the profit on cost margins are low, if we look at a cash on cash basis, it's actually extremely high, because you can typically you can knock over a cosmetic renovation project in, say, 3, 6, 9 months time, and if you're getting a certain amount of profit and cost, if you annualize that, and if you look at the cash on cash, you can be looking at 20, 30, even sometimes 40%, which is huge. And then you look at projects where it's a longer period of time, but with a townhouse project, you're not dealing with some of the uncertainties of, say, renovation, where you can knock over a wall and you go, oh, what's here behind this wall? There's a lot more certainty in some respects, and some others, and uncertainty in other respects, like getting a DA through particular councils, for example. So horses for courses, and again, we'll look at deals on a deal by deal basis. There's no we won't prejudice. We won't have a preference for certain renos over certain townhouses. From our perspective, as long as the deal stacks up on its own, it's something that we'll fund. We're happy to issue happy to look at it and issue a term sheet as such.
Very good. There's that term again, term sheet. So we put that fish hook out there. So let's go grab it right now. So term sheet. What's a term sheet, mate? I've put my application in, and you guys have assessed the deal, and you give me back a term sheet. Does that mean I've got the cash?
A term sheet is an indication from the lender to provide funding for you, and it'll typically outline conditions. So things like interest rate, what are the fees, what are the next steps that you need to take, how do you go about ordering the valuation. It's an indication of interest from the lender to provide funding for you. Usually there are some conditions attached to it, for example, as per valuation. So do the numbers in your feasibility actually stack up with a valuer? If we've said it's $1 million for the end sales values and it comes back at 1.1, then fantastic. If it comes up back at 900, then the lending may change a little bit. So it's important to know what some of those conditions are. And one thing to look out for is what sort of fees are involved. And a key part of what we do is transparency and letting people know upfront, here's the fees, what we charge and what we don't charge, and making sure you know what you're up for.
So and you've touched on a really good point. There's a number of fees that different lenders out there will actually charge. Some of them will actually charge, a fee just for even looking at the deal. Others will charge, only when the term sheet is actually issued, and that gives certainty. Then there's, what is called a line fee, and then there's the interest rate itself. So let's break a couple of those down and give people a little bit of an understanding on how and why those different approaches exist and what those things are. So, for example, what's a line fee, mate? Like, I know what it is. You know what it is, but tell our viewers what we're talking about here.
Yeah, it's a line fee. Line fee is a fee on drawdown, which taking off my financier, putting my developer hat on, is actually just, to be frank, just an excuse for another fee. I'm a bit against line fees myself, because there's no justification. It's like paying a bank to do their paperwork. And look, typically it could be point something of a percent. It could be 1%, and it's let's say you're doing drawdowns on a monthly basis, that could be charged to you on a monthly basis. We don't do that at CrowdProperty because we don't see a reason to justify for it. It's just an excuse for a fee. Rob, I'll be completely frank.
I hear you, mate. Let me paraphrase how I've heard it explained to me by other lenders who do charge it. So let's just say that you need to borrow $2 million. And as you said, you're going to draw down that $2 million over a period of 12 months of construction. So you haven't got $2 million taken out day one. You might take out $200,000 the first time and $400,000 the next time, and that sort of thing. The justification is, well, they've reserved that $2 million and they can't lend it to anyone else. So it's sitting there not earning money, waiting for you to pull it down. And the only time you pull it down is sometimes 8, 9, 10 months into the project. And at that point, they actually start to earn money on it. So that's the justification that's been used to describe it to me in the past. I'm quite happy to hear that you guys don't see it that way. But it's important when people are actually starting to look at their fees that whether a line fee is there or not, that they're not looking at, or whether there's an application fee or not, whether there's a terms fee or not. It's about looking at all of them combined and going, what's the total cost here, right? Because you can have a much lower interest rate, but by the time you add the fees, the actual bottom line cost to you is much, much higher.
Yeah, absolutely. That's where it's important to be aware of the fees that you're up for. And part of looking for a good lender, a good financier, is to figure out, ask them about the fees. What's your line fees? What are your other fees? What are your hidden fees? Just ask them about it and see what they say. Test them on it. And there are some stories that you hear about some of the lending practices that are out there, which we don't agree with, and we're all about transparency. We're all about being upfront and not changing the numbers right at the last minute too. So, for example, with us, you can come to us with your deal. We're happy to spend some time talking to you about it, and we're happy to look at other offers you may have and provide some help with it, just to differentiate what's good, bad, and ugly about those deals. We'll never charge to issue a term sheet, so you can present your information. We'll issue a term sheet for you, provided the deal works, and happy to continue having that conversation with you until you settle and construct and exit the deal and potentially go again.
So thank you, mate. And so you mentioned before the term sheet is the conditions that you're going to apply and the fees that are going to apply.
Mm.
Is it safe to say that once somebody complies with those conditions, that the term sheet is a guarantee for lending? Is that conditional, obviously, on the fact that you meet all the conditions or subject to, but is that certainty? So when somebody says, look, I've got subject to finance in their application, on their purchase, is that all they need from you guys?
Yeah, so typically with us, we highlight any issues that we foresee in the term sheet. So, for example, if we're saying that it'll be subject to your DA, we would have typically seen that DA previously, so we know that it's good. Can't speak for other lenders there, obviously, but look, typically when we issue a term sheet, that's pretty much on the mark, and there are a number of CPs that need to be met. So, sorry, to put another jargon out there, conditions precedent, and once we meet each of those conditions precedent, we tick them off, and once we meet all of them, then the funding is there.
Very good. So one more piece of jargon that we've not touched on is the actual application itself. Typically, the application, the developer would put through what is called an IM, or an information memorandum, to give, I guess the lender, a little bit of a view as to the deal and why you want the money in the first place. So, mate, what goes into an IM, or an information memorandum?
Yeah, it's a very good question, and the short answer to that is hopefully a lot of thought. And we review deals on a daily basis, and we've seen some really good IMs done very professionally, and we've seen sort of the opposite end of that. And I guess what we're looking for is what it is. It's an opportunity for the developer to really showcase the deal. Tell us about what you like about the deal. Tell us about why you got into the deal in the first place. Sell it a little bit. We expect certain things in there. For example, your feasibility, your maybe a summary, and we can ask for a detailed feasibility later on. We want to see where you see the end sales values of your product, and some of the comparables that you've gotten in your research to see where they sit. Is it a better comparable compared to your product? Is it a worse comparable due to the finishes in your product? What sort of team you have, as we talked about earlier on, who you've chosen in your team, or why you have people in your team, and some of the risks and mitigations that you've got. Now, one thing I do have to say is, look, just be upfront with your lender. Like if for example you're in a flooding zone, like we're going to know about it, right? And if you don't have a mitigation plan for a flooding zone, we'll find out later on. It's much better to be upfront about it. But don't just tell us about the risks. Tell us about your methods to mitigate those risks in your project. So it gives us some comfort in the fact that you've thought about your project and how you're going to mitigate the risks that are there. Separately, you can put a company profile or a capability statement. Some people choose to put that in there to showcase some of the projects they've done, or you can have that as a separate document. That's bonus points. It allows us to know a little bit more about you, what you do, and also property development is and Rob, you say this a lot. It's a problem solving game, and if you can demonstrate in other areas of your life, whether it's in business or elsewhere, that you can solve problems, and you solve some pretty big problems, put them in. That's definitely relevant experience in the property development game.
Absolutely, mate. So, okay, in the interest of time, we're going to go grab some questions from the audience in a moment. But in the interest of time, what are some of the common issues and challenges that you see when applications come through? What is the most common problems that you start seeing on your applications?
Yeah, so there's probably, there's a whole array of issues, but one of the ones that we typically see is, look, there's not enough equity in the deal, right? So let's say you don't have that 30%, and a lot of times developers want to do deals where they're putting in little or no money into the deal, which is fine. It's good to ask, and as a developer, you want to be doing that. From a lender's perspective, what we're looking for is what we call some skin in the game. Whether that if the project should turn the other way and not go the way that you want it to, whether you've got some hurt money in the deal. So having some equity in the deal is good. Having lots of equity is even better. But I recognise that with every developer, you're trying to do multiple deals, so that equity, that money is precious. Another one we see.
Well, I was going to say, luckily, there is that solution to that, which is the pref equity side of things. So by owning that up front and saying, look, I am short here, that can be factored into the application itself.
Yeah, absolutely. Just be upfront with us and tell us where you are with equity. And if you're short, that's okay. That's another solution for not just you to solve as the developer, but for all of us to solve together as a team. Another one that we see is incorrect product. So again, we use that example of you're in a retirement area and you're building 2-story townhouses or 3 or 4-story townhouses that have too many stairs to climb. So is it the right product, and are you pitching it at the right pricing for that particular product? So that's just something to be mindful of. A great example is a deal that we saw where you could easily put 8 townhouses on what was it, just under 2,000 square meters block of land, and the actual better product was actually just to go lower in number, make them single level, and try and sell them at a higher price, because there was no price capping in that suburb. It was much more about having the right product in that area.
Yeah, there's a thing called highest and best use, which is not necessarily the maximum density. It's the most amount of money in the least amount of time with the least amount of hassle. So sometimes selling something that is fit for purpose in the market and selling less of them, you'll get a higher price point for it.
Mm. Yeah, absolutely. And yeah, horses for courses. And another one that we typically see is GST. It amazes me how often that's misunderstood and misrepresented. So an example was recently we saw a feasibility that came in at just under 10%, and there was no mention of GST. It was 1 into 3 in New South Wales. We looked at that deal and we said, oh, there's something not quite right about this. Yes, you've got the end sales values spot on, you've got the purchase price, but there's a house on there. You can apply what's called a margin scheme on that. Now, without going into too much detail, as part of the calculation of GST, and just with that one line, we were able to add back a substantial amount of profit for this developer. And so, the GST is important. It could also work the other way and take away margin from you. But how you look at GST and how you represent it on your feasibility does go a long way to show your competence and your understanding from a numbers perspective for the deal.
Yep. So, which leads to a really good question. When somebody's putting an application in, do you want to see everything GST inclusive or everything GST exclusive? Because the number of times where I've seen people have some that's inclusive and some that's exclusive, and it's really a bit of a hodgepodge.
Yeah, absolutely. Look, our preferred is exclusive, but if you have to do it inclusive, then that's fine. We can work around that. What we do ask for is to be consistent. So don't have some figures that are GST inclusive and some, because that will confuse, and that'll just make everyone's life a lot harder.
Yeah. Any other common question? Any other common problems, mate?
Probably the other one is that we sort of touched on is deal's too big, or deal is, I guess, beyond the experience of the sponsor. And we already spoke about how some of the ways that we can mitigate or for us to be more comfortable with the level, and that is to have a supplementary sponsor, having another sponsor on the deal, having a mentor, or having another project manager on the deal, which will offset some of that experience. And we've seen a lot of these deals work really well when you've supplemented with somebody else, and it's not atypical. You know, and like I said, there's always a first time for a deal size, and that's okay.
Yeah, very good. Well, what we might do at this point, mate, we've just hit the hour, so we've had a fairly good crack at this. What we might do is reach out to see all of our users out in LinkedIn and YouTube and Facebook and see what sort of questions that they've got out there. So give me 2 secs while I navigate through about 12 screens to make that happen. So lots of people saying hi. So Robin, Peter, Nathan, and a whole bunch more. So hi, everyone. Nathan's got a question. He missed the beginning, but I know Daniel does crowdfunding, but it seems like the topic so far has been commercial. Is that right? Well, I guess
yes.
we've been talking about the difference between residential and commercial, Natalie. So that's really, I guess, the whole point of the conversation. But really, you guys are lending in that commercial space, yeah?
Yeah, correct. We're lending in that commercial space, and again, going back to the point we mentioned earlier on, which is it doesn't affect the nature of the deal. So if you're doing a 1:2 or 1:3, which also works in residential lending space, you can also get commercial finance for those deals as well. So it's not mutually exclusive. Commercial finance extends to across the board, and provided it's property development, we can look at it.
Yep. I've got a question here from Phoebe. So Phoebe says, for the 20% profit on cost, does it matter if the project is for 1 or 2 years, or are you looking at 20% on cost per year? Do we need to annualize it?
No. So Phoebe, all you need to do is show us what your profit on cost is for the whole project and what you think that time frame will take. And if you think it will take 18 months, let us know that. If you think it's going to take a bit longer than 2 years, and some projects do, and that's okay. You just let us know. But that magical number of 20% applies to the project overall.
Very good. Next question is from Andy. So Andy says, are there any restrictions or challenges in using a resi loan for the initial purchase and then moving on to the commercial for the construction phase?
Not at all. In fact, a lot of our lenders do that. So, for example, if you're purchasing a house and you can get an 80% LVR on the deal to settle the property, that's perfectly fine. And what you typically find is if you get a DA, as we spoke about earlier, you can actually uplift the value. So we can then, from a commercial funding perspective, recognize that you've added value to that, and potentially lend you more. And I guess we can get into project-related site value calculations, or maybe that's reserved for another day from a valuation perspective. But we then do a reverse feasibility on that. We look at the end sales value, and we take out the build cost, the soft and hard costs. We take out consultants' fees, your profit margin, and we say, look, now it's no longer 1 million. We think if you put that back on the market today, we think it'll be worth 1.2. We then can recognise that. So there's no issues with that. One thing to be aware of with that arrangement is you are paying back so that initial loan with the resi lender will need to be paid back. So just be aware of the consequences. Maybe it's a broker that's done that deal for you. Just be aware of some of the fees associated and some of the timing around that, because that loan, that's got a first mortgage over your property, so that'll need to get financed out at that point.
Yeah. Now, next question is from Gordon. So I hope I said that correctly. First time here. Unfortunately, he's written everything in shorthand, so I'm going to try and interpret what he said. Doing a 3-bedroom residential development, is it better to do residential or commercial loan? then he's gone on to, that's part one. Then he's gone on to part two to say, it seems if you have less than a 20% deposit, then commercial loan is a better way to go, as it's assessed over GRV and not, I guess, typical loan to value ratio.
So that probably depends on a number of factors. And, we spoke about serviceability earlier on, and we spoke about how many projects you might have on the run. Look, we're happy to look at those deals, provided they are good deals and deals that make sense. Ultimately, it's up to you as the developer to make the decision of which path you head down. So if you're looking at one of your first deals, then maybe explore, if you're doing, was it a 1 into 3 development, Rob?
Yeah, 1 into 3.
Yeah, if it's 1 into 3, there are resi lenders that will lend to that, depending on the amount of income and serviceability you have. But we'll happily look at that as well. And like I said, ultimately it depends on your goals, whether you want to scale up and do multiple deals. It depends on your own circumstances. We can't give financial advice on this one, but it's one where you need to weigh up the pros and cons of doing a deal. But I will say this, which is you're absolutely right. If you don't have the amount of deposit or equity to put into that deal, you will find far more flexibility in a commercial environment. So that's that's a bit of input I'd like to leave you with.
Well, I'd also add to that with a little bit more flexibility and say that the residential guys are going to be looking at that as if it's a 30-year loan. So they're going to want to know, are you keeping the stock at the end? Because they're expecting that interest over that 30 years. And so they're going to have to assess what's the rental return that product is actually going to be generating. And the moment you tell them, oh, no, I'm just going to flick it, they're probably not interested in it in that residential space, because they're not going to get interest over 30 years. They don't want to, I guess, give out cheap money on a high-risk project and only get interest for 12 or 18 months.
It's true.
Next question is from Ursula. So do you charge interest on drawdowns?
Do we charge interest on drawdowns?
Yes.
So we have an overall interest that we charge on the whole loan, and that's very clear up front with any term sheets that we issue on the deal. And so in our term sheet, and that may be different from other financiers, is we'll say, look, your total loan amount is X, and your interest that you're up for is Y amount, and typically that will remain where it is. Now, if the only change to that is if you, let's say you've got a 15-month loan and you finish your project in 13 months and you've sold and settled, then we say, congratulations, Ursula, you've completed your deal early, and we'll only charge you interest for those 13 months, not the 15 months. And we don't penalise you with early exit fees or any other fees, because you should be rewarded for finishing a project early, right? Conversely, if you extend the loan, if you run the loan longer, so if you run into some problems and you say you need a 2-month extension on that, then you get charged the extra interest on that as well. Now, the key here is to communicate with your lender and tell them that you might be running late, not the day of, not on 15 months. Let them know early, and there are things that you can do, and the lender can work with you to figure out what your options are. The key thing is communication. So let them know early if that is the case. But hopefully that answers your question.
Yeah, it does, mate. Next one we've got from Declan. So from a feasibility perspective, so when they're trying to put together their budgets up front, what sort of percentages for interest rate should they consider for both the interest and also any application fees, etc., from yourselves?
From us, yeah, that's a very good question. So our interest rates start at 8%, and then from there we've got a 3% fee, which is only charged upon settlement, not term sheet issuance, only on settlement. So what that means is we forwarded you that money, and that fee is charged. It's we don't charge any early exit fees. There's no line fees. Any costs with regard to valuations, QSs, etc. That's charged at cost, and you may see a lot of the markups with other lenders. But yeah, no, absolutely free to get a term sheet essentially.
Very good. So next one is from Vanessa. So valuations are always conservative in any market, but with this market moving so fast, how can, like, firstly, how does someone like yourselves start to deal with that? And then secondly, how can Vanessa try to combat that and go, well, how do I actually show you where the true value is?
That's a very, very astute observation, actually, Vanessa, because at the moment you've got rising build costs, you've got rising end sales values, and sometimes valuers aren't quick enough in catching up with that. One of the things that we've seen on a project is getting away a pre-sale, which then sets the precedent. I think that will go a long way. So let's say you're building 6 townhouses, you get one away, and 6 months ago you may have done that feasibility at, call it 800,000, but you may be selling this same product at 900,000 today. And if you've got that on a 10% deposit on a contract, it's very hard to argue against because it's fact, right? So the other things that you can do with your lender is say, look, if you're short on certain funds, if you're short on equity, can you examine other aspects like your MES, your pref equity option? And the other thing is, again, it's commercial finance, so there is a degree of flexibility. We recognise that it's a moving target every day, so there might be some flexibility, certainly from us and from other lenders, to recognise that at the moment to allow for a slight change in LVR, for example. But again, deal by deal basis, provided it's a good deal, we're happy to examine and bend the rules a little bit depending on the deal.
Very good. Now, next question is from Phoebe. I think you've already answered this one. So indication of interest rates charged. So we've already kind of grabbed that. So just acknowledging that to Phoebe. Jerry's then asked a question, hey, Daniel, what's your surname? And we've got it on the link below, Jerry, in case you missed it. So it's Daniel He, and his contact details are there. And her observations are that everyone seems to know you, mate. You seem quite popular in here. So you clearly get around.
I'm hoping that's a good thing. So hello to everyone out there.
Very good. So Linda's got a question here. So I typically rely on private lending. Happy to pay and have full control of my funders where they trust me. Takes the I guess JV pressures of personality out of many things. I think it's more a statement than a question. So have only used bank lending on 1 into 4 deals. So maybe I can turn that into a question. I guess where people are using private money, so I guess individuals in the network, what makes flexibility of, I guess, a commercial solution a little bit better than private lending?
Yeah, I mean, a lot of times commercial lending, private funding, non-bank lenders, you're looking at the same pool essentially. I think then at that point you're from a developer's perspective, your criteria might be different. It's no longer about, okay, well, is it 8% versus 8.5%? Is it 1.5% of fees or 1.25% of fees? We know that the top things that developers look for are transparency, knowledge. It's not atypical. We heard this from a developer about 3 months ago. He applied for a loan, resi space, in January, and ended up getting the loan approved and settled by the end of June. Now that's 6 months that you wasted in mucking around with one deal, and in that time you could have spent that time doing other things. So I think you've got to weigh that up in the overall bigger picture. And I think at the same time, like, you've only got a finite amount of time, right? You've got a finite amount of time to deal with personalities. You've got a finite amount of time to look for deals, and so it's part of your scaling up journey, and that's where we come in to help you in that journey.
Mate, we must be really popular with this topic because the questions just keep on coming. So hoping you've got a little bit of time to hang on for a couple of minutes still. We've got another one.
Unless anyone's coming through for trick-or-treating, I'm all good, Rob.
Very good. Next one, we've got a question from Gautam. This is actually one for me. So, Rob, is there a feasibility calculator for beginners which can be shared? Yes, absolutely. I have one called Quick Feeso, so QWIK Feeso. If you go to our Developer Network website, to our shop, you will find it there. Now, Karen's got a question. Is interest capped at the end of the project or monthly? I think she's meaning capitalized. So is interest capitalized at the end of the project or monthly?
Yeah, typically it'll be capitalized, and we addressed this earlier on, which is cash flow. The whole point of having capitalized interest is so you're not paying out of your own pocket throughout the journey of 6 months, 12 months, 18 months. Can you imagine trying to do 4 projects and every month you've got to pay out a certain amount of interest just to service it? So we roll that up and that gets discharged at settlement, which helps with cash flow a lot.
Very good. Next one is from Rashan. So firstly, comments saying great discussion here. So his question is, how do you factor in risks of a potential major market pullback? Say, for example, a 10% pullback in the market when you assess each deal. And then on top of that, as a supplementary, how do you manage this risk across your portfolio, across your loan books?
Yeah, that's a very good question. And I think assuming he's asking that from a financier's perspective, not a property developer perspective. So we have a very stringent process to examine every deal, and we have a series of data that we rely on. And without going into the IP of that, one of the things that we look at is how much properties pull back in times like the GFC, for example. So we take that into account in the calculation. We take that into account into data sets, and there's various ways using market data. You can almost predict where property is looking is going to be looking at in the next sort of 6 to 12 months. Now, we don't rely on any one data source. We rely on multiple data sets, and we make an assessment based on that. And the term sheet and the offer will be reflective of that. So, for example, if a deal is in an area where we think it will pull back quite significantly, that LVR might be a little bit lower. If it's an area that we think will continue to do well or not pull back as much, that LVR will be potentially right up there at the full 70%.
Yeah, and picking up on that, and I'll just push Roshana back to some of our previous Sunday sessions where we've talked about how to start to predict the market for yourself. The difference is looking at market indicators versus market drivers. An indicator is a measure of something that has already happened. So, auction clearance rates, well, that just happened, right? And people that are looking at something that just happened, that's not really telling you what's about to happen. So market drivers are telling you what's about to happen. So interest rates, unemployment rates, population growth, all those sorts of things. Government spending lots of money on projects and creating jobs, that sort of thing. So go start to look at the market drivers, and that will give you a good indication as to where the market's going.
And that's very important. Sorry, just to expand on that a little bit, which is you're in the deal for a development, say 18 months. So it's important to know where you are going to be in 18 months' time, not just today's market, because that will and can change fairly quickly, whether it's better or for worse. So it's important to account for that, and that's, I guess, also partially, why you have a profit on cost margin. You've got a margin to work with to have some of that safety buffer for the project as well, in case it pulls back.
Peter's got a question. As a lender, how do you guys feel about the developer taking out directors' fees, or I'm going to assume project management fees along the way, to put food on the table while the project's actually running?
I would probably say this. If you feel the need to take money back out of the project, I would account that, and I would say, look, just take it out at the beginning and just say you've got less equity in the deal in the first place. Because ultimately at the end of the project, you will have a certain amount of equity in the project, and that's what we want to be looking at. So if you're going to take a project management fee, that's perfectly fine. But take it out at the front, or if you want to take it out earlier, we can just say, look, you would have had 200,000, you want to take out 100,000, then you've only got 100,000 of your own equity in the game. We'll examine it from that perspective. So there's no right or wrong. I mean, depending on how you've arranged it with your equity investors or JV partner or otherwise, you're entitled to that if that's part of the agreement. It just affects how we look at how much equity you've got your own in the deal.
Well, I guess in the end, it's another cost of the project. And so if you're adding it as a line item cost, then that's going to be accounted for with, I guess, small amount of extra equity, small amount of extra interest, all those sorts of things. So the flexibility of cash flow early has a penalty at the tail. So that has to be considered as well. Okay, Jerry's got a question. Just trying to see if I can interpret it. Okay, are fees deducted up front? So, for example, if I've got a $700,000 loan and I'm expecting $60,000 in fees, we're just making up that number, would it actually be a $640K loan that you're lending because you've already deducted the fees out of the debt?
Yeah. So how that works is on our platform, we would raise that full amount for you of the 700, and we would then withhold some of those fees and release to you that slightly lower amount. At the end of the project, you would pay back the full amount of that. So it's not that you need to dig into your own pocket to further put into the deal. It's just the amount of release that we give you is slightly lower. But that's all very clear in the term sheet. We'll say, look, this is your full gross loan amount, this is your net release amount, and this is the amount of interest that's going to be charged through the loan. So it's very clear up front what you're in for, and it's written in plain language without too much jargon. I hope we haven't had negative feedback on the jargon on that. But it is very clear, and look, we're always happy to chat if it's not clear at any stage.
Very good, mate. I think we have smashed out all of the questions. So, and we've run very much over time than we are anticipating. So, Daniel, I want to thank you very much for your time. For anyone wanting to get hold of Daniel, his contact details are on the little link below. And, mate, is there any parting words that you want to say to anyone before we go?
Other than the fact that look, it's a hot market out there, and deals are out there. Keep looking, keep digging. If it's if it's a good deal, the key part of property development is the entry point. If you find a good deal that's worthwhile, you'll get JV partners, you'll get funding, and you'll have a good product at the end. So that point of buying in or optioning in is really, really crucial. So don't be afraid to reject deals that don't work, and don't be afraid to be bold and move forward with the deals that you think are good and profitable.
Very good, mate. Thank you very much. And for those of you out there who enjoyed today's session, I guess Daniel and his crew are going to come on a semi-regular basis and try and add value to us. So I want to thank you very much, Daniel, for your time, and we will catch you at our next episode, mate. So signing off. See you, folks.
Thanks, Rob. Thanks.